62% of Americans own stocks, and a lot of them are getting their trading tips in the same place that they get their news, social media. But these so-called Finfluencers are pretty poor at giving financial advice, according to a new study. And I know exactly why. Doomerism is great for virality, but pretty bad for investing. That's not the worst part of the damage, though, because while people are losing money, they're also losing trust. And it's much harder to rebuild trust in the world that we live in. This study, aptly titled Finfluencers, dives into the tweets of over 29,000 financial influencers on Twitter, and it shows just how bad their stock picks are. 56% of them have anti-skill, meaning that their returns are negative. Quite negative. They're losing 2.3% a month. That's an annual return of negative 24.2%. So if you invested $100 at the beginning of the year based on their picks, you'd have $75.80 at the end of the year. Here are some common financial products that would probably do a lot better of a job. Researchers also found that these anti-skilled influencers are more pessimistic. So not only are people getting bad financial and life advice, they're getting it based on a bad outlook on the markets and the world at large, which creates the problem of doomerism and perpetuates distrust. The S&P 500 is up 434% since 2000. The reality of the market is the complete opposite of doom. It shows that real people are putting real money into something that they expect to grow, because markets are trust reflectors, not doom machines. Take the rise of meme stocks like GameStop and AMC. They've become so popular because of Finfluencers like Roaring Kitty. People want exposure, but the volatility and the divisiveness of those stocks starts to make people view the market like a casino, a place where the so-called deep state is working against them to make them lose money when really it's just bad trading. And the societal rift is becoming harder and harder to fix, and the question is, well, how hard? And the Harvard Youth Poll has an answer. Nobody trusts the media, trusts the government, or trusts Wall Street. The speed at which young people are losing trust is scary. How does this connect to the Finfluencers? It's hard to get clout without attacking those who have it. Like the Bureau of Labor Statistics, the boringly named and heavily staffed agency of statisticians. A blatant lie went viral about coffee being removed from the CPI, the Consumer Price Index, what we use to measure inflation. It was an attempt to prove that inflation is worse than the government say, but it was a misunderstanding of how things are calculated. The BLS had to step in, address the tweet, but far fewer people saw that tweet than saw the lie. And those who went viral are laughing all the way to the follower bank. And the thing is, the idea behind Finfluencers isn't bad. We do need people to explain the market, and I'm one of them. And we should encourage people to invest, but without this doomeristic, misinformation-baked lens. It creates a lot of deep problems, and in order to even begin rebuilding trust, we need to expect more from those who claim that they know where the economy is going. We need to have higher standards for the information that we use to invest our money, because this certainly is not it.